Hey, good afternoon, everybody. Going to go over our trades for today, Tuesday, October 13th. No trading yesterday as it was Columbus Day holiday here. Banks were closed, and as you know, banks are major players in the currency world. So we decided we don't trade on those days. Bond markets were closed as well. Stock market was open, but it was pretty muted activity. We had one trade, got stopped out, lost 54.9 pips or 11.0 pips on a size adjusted basis. We'll go over that in a second. We did have two trades this morning that we've pieced out of, but we still have some. So at the time of this video, and we'll be talking about them tomorrow's video. Not much economic news to speak about either today. There was a piece from Goldman Sachs I want to speak about, and then also the Fed's Bullard was making some comments. I'd like to go over those real quick. Other than that, really no economic news to talk about. Goldman Sachs is the latest firm to pretty much throw in the towel on the labor force participation and unemployment. They say that unemployment will be about in the 4%, 4.5% is their target. They say lower labor force participation means a considerable amount of labor force slack. They say labor force participation rate is more structural shift in the economy rather than a cyclical phenomenon. So they're pretty much throwing in a towel, as so many other firms have done, and basically saying this is the new norm. At that unemployment rate, you're talking, and the high, or I should say the low labor force participation rate, you're looking at up somewhere in the neighborhood of 100 million people that are out of the labor force for one reason or the other, whether that is they're too young or they're too old or they're just not receiving unemployment benefits anymore, and the government just doesn't count them. No matter what their age, they could be a 32-year-old person that got laid off, collected their unemployment benefits for the maximum amount of time, and could not find a job, and the government considers them segueing, as the government says, they're segueing into retirement. I don't know about you, but when I was 32, I certainly couldn't segue myself into retirement if I couldn't find a job. Anyway, as far as Bullard, he's one of the most high-profile Fed people in the Fed, so it's good to see what he says. To kind of go over what he's talking about. He said liftoff is appropriate despite challenges, which I thought was pretty surprising. Challenges not sufficiently robust to guide policy will be exceptionally accommodative, even with hikes. So he's saying even if the Fed were to raise hikes, they would be ready at any moment to if they were raising interest rates. I think I said raising hikes. If the Fed were to raise rates either October or December, if things turned, they would be very, very quick to just lower rates back again. So that was, one good thing that he said, I thought. He says estimates of long-run unemployment tending to drift lower. Unemployment rate will go deep into the 4% range. And that's pretty much what Goldman Sachs had said as well. He says he does worry that zero rates will foster financial market excess. I certainly wouldn't want to argue that point, but if I was able to speak to him, I'd be saying, well, don't you think we're already at financial market excess from what they've done? And there's a direct correlation to the Fed's balance sheet increasing from under about $900 billion, $850 billion to over $4 trillion. You can see the direct correlation between that balance sheet and what the stock market did. Sorry, I don't know if you hear that buzzing. We got maintenance guys working outside. Long economic recovery doesn't increase odds of recession, is what he said. What else? He says the Fed and the market liftoff still a mismatch, and he says they need to reconcile that. So it sounds like he's trying to warn the market that the Fed is going to move this year, whether it's October or December. And he says that the market he believes the market's not reflecting it properly. So he says the market needs to reconcile that, which I would have to say, you should look for markets to move down as far as stock markets, and look for the US dollar to move higher. He says October's tough to make a big decision. Hikes would be slow, gradual, and won't impact emerging markets. Now, it sounds to me like he's saying that October's pretty much off the table, and it looks like the Fed's really leaning to a December rate hike. And he says that they will be slow, and Janet Yellen has backed that up many times, and I believe that. I think the Fed will, whenever they do start raising rates. I mean, it's not if, it's a definite when they're going to. They're definitely going to do it at a slow and gradual pace. What they have to hope for is that it will not impact emerging markets, and that was one of the things he said in that comment. So the lot of fear on the streets now lately is that if the Fed, look, ECB is nowhere near ready to raise rates. Japan's nowhere near ready to raise rates. China's nowhere near ready to raise rates. The Eurozone, the ECB, they're still doing QE. Japan, they're still doing QE. China's economy is collapsing. They're about to do QE. Matter of fact, the UK just announced deflationary numbers. Parts of Europe have already announced deflationary numbers. In the United States, really, we're on the cusp of announcing deflationary numbers, but the Fed is trying to maintain some type of credibility, and they want to raise rates. Instead of just saying we need to raise rates to normalize them, to create good inflation, just what we've been arguing, instead of going down that road and saying that, they want to tell us they're going to raise rates because the economy is so strong. Whatever. That's a whole another conversation. We've spoke about that in the past. But the fear on the street is that if October, December, or to begin time, next year, that the way the world markets are, the world economies are, especially emerging markets, that it's going to impact emerging markets, and you're going to have an emerging markets crisis, and that could be the next global crisis that happens in 2000. 8 years ago or so, 2008, we had the financial crisis that was fueled by the housing market. Started here in the States, spread. It was a contagion, spread around the world. What the street is fearing now is this emerging markets economies are going to collapse, and they've started slowing tremendously, and they fear that if the Fed starts to raise rates, especially if they don't raise them as slow as they're claiming they're going to raise, if they actually pick the pace up a little bit, that those emerging markets will absolutely collapse, and it'll create a crisis, another financial crisis that will spread around the world as a contagion, and this time it would be from those economies. So it's just wanted to put it out there. That's what the fear is lately. As far as our trade here, like I said, we had this one. We had a couple others. We had EuroCAD that we were long and short Aussie US dollar. We're going to have those in tomorrow's videos because we were piecing them out. But this one we got completely out of. And as a matter of fact, this was a short in the Swiss franc to Japanese yen. We were short from 124.324. You can see pretty much short at the bottom there. The momentum just never came in on the scalp. Went against this. Our stop was up here, 124.87, got out 124.87.3, losing 54.9 pips. Honestly, we had 20% of our normal size. The size adjusted basis, 11 pips. And you can see this was all happened overnight while we were sleeping. You can see what it did. Right after stop this out, it came back to be down about, it's about 10 or 11 pips, thereabouts. But then started to rally again and actually went through the figure of 125 and traded as high as 125.11. Got to figure that's about 125.14.15 on the offer side, because these charts are the bid side. So no matter where you had your stop, unless you have a upwards of 100 pips, you would still be in it. So, but we'll take it. You know, that, I mean, not that we'll take it. We'll take the beat. You know, the beat up here. These things happen, right? The crazy part, unfortunately, we were looking at Canadian dollar, Japanese yen, and New Zealand dollar, Japanese yen. Unfortunately, this is the one that got triggered, and the other two actually, if they got so close to being triggered, and they could have worked out, but not tremendously. You know, rather small, about 20 pips of either side of things. So size adjusted, you'd be looking at 3 or 4 pips. But you know, better than losing 11, right? Unfortunately, they didn't get triggered, and this one did. So, but that's it. So we'll move on. Like I said, that one trade lost 11 pips on a size adjusted basis. We'll have the others tomorrow. The Euro CAD, Aussie US dollar, and anything else that gets done tonight or tomorrow morning that we're completely liquidated out of. That'll be in tomorrow's video. So that's it. We're gonna wrap it up. If you're still trading now, good luck. If any signals come out the rest of the day, they'll be heading your way. And have a great rest of your day. We'll see you tomorrow.